Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Jeremy Reddick with Virtue Capital over in Brentwood, Tennessee. They are the advisor to advisors around the country. And one of the things we've been talking about is one of the strategies that I was introduced to through Jeremy's firm that not through lack of trying. I want you to know I research all the time. I read daily. I get a lot of newsletters, a lot of different industry things that I look at. And in that, and of course the same things you're looking at as well, some of the business news, some of the stuff, of course, out of the Journal and Financial Times and the like. One of the things that we see, of course, when it comes to investing is how the market has gone over the last basically about 12 years, this large run up with large caps, and how we can, in fact, help improve on how we invest. Jeremy was talking about, in fact, and this is just one of the things they do with advisors, is helping them navigate these same things. And they have even more research pieces, more research resources available than someone like myself would have. And that's been a big help. And that's where the stop loss overlay came in. As Jeremy and I have been talking over the last couple of years about stop loss and about some other equal weight index versus market weight, some of these different things, and looking at the research and looking at what's available to compare how that could improve the portfolios that I use with my clients, came up with some great strategies there. One, the equal weight index, and of course another thing to be looking at is on the bond side. We can talk about that later, but having the right mix of stocks and bonds is where you start. It said the asset allocation is the first and foremost most important. But then, Jeremy, coming back to the stop loss overlay, this allows me to now, or one way I can do it, I can either use it in a current portfolio to reduce my risk, or I can use it as a means to increase my equities, still managing my risk, still maybe even having less risk than I would without it. For instance, what I've looked at is a 60-40 portfolio, which is a pretty standard, moderate, commonplace type of mix. Yeah, 60-40 you see pretty widely used, 60% stocks, 40% bonds. And when done correctly, that can reduce your risk to that about half of what the market risk might be otherwise, comparing it, say, to the S&P 500 index. However, when we look at how we can make it even better, now if I want to increase my equity component without increasing my risk, my volatility, this is where the stop loss overlay, I think, works really well. One component of this is this asset allocation piece that we were talking about when we left off about the stop loss overlay, was that about market weight versus equal weight. And I think, and as you mentioned, the top holdings in a S&P 500 index as an example, the top, I think it's 25 holdings make up, as Jeremy said, 41%. Almost 50%, yeah, 40% of what kind of return you're going to get. Well, let's take a look. I've got a slide here, Jeremy, that's on the stop loss portfolios, your piece, that shows the equal weight versus, in this situation, we've been talking about asset categories like large caps versus small caps as an example. Now we're talking sectors, and that just slices up the market a little differently.
Yeah, so there's 11 different sectors within the S&P 500, right? Regardless if you're market weight or equal weight, it doesn't change how many sectors there are in the S&P 500. What it does change is what the weighting is to those sectors. And no different than certain stocks will outperform or underperform their peer group, it's the same way in the sector market. And when we look at that, you can see here the biggest one that stands out is information technology. So in this slide, you'll see that equal weight is 25.5% weighted into information technology, where equal weight is only 15.6. It doesn't mean that it's a negative that you're invested 25.5%. That's not a negative unless that sector's not doing well. So it's very important, or we believe that it's very important to consider blending the two together, because you don't really know. We don't know. We know what we think is going to happen and which sector are going to be in favor, but it always doesn't happen that way. So different weightings with S&P market weight versus equal weight for each of the 11 different sectors that are available.
And this is one of the areas. So when we're looking at diversification, it's not just asset categories, it's also sectors. We don't want to be too heavily weighted, for instance, in tech. Now, there are times, just like being heavily weighted in large caps, when it pays off. We get a big run-up,
like
as
the
we've
last few
seen.
years, yeah.
Yeah, exactly. But that doesn't mean that that's your long-term strategy. That means that, when they go up, what happens? There's going to be a reverting to a mean, an average that they are going to revert to. An example being the S&P is up over 15% a year over the last 10 years. However, if you look over the last 20 years, it's only about 6% a year. So we got to wonder, well, is 15% sustainable? No, not likely, right? But we want to stay invested. We still want to make sure we're getting that market return, but we start with asset allocation. We blend some other things in. We don't want to have everything in large cap. We wouldn't want to have everything in tech. That's a great way to lose all your money, or at least take a pretty big lick when in the next bear market.
And heaven forbid it's right when you retire, right? Going back to your point either, going back to a sequence of return risk, which is a huge risk. So we see that all the time where folks are heavily invested in one area of the market and they don't even know that. Another area that we see when we first meet with clients, and a lot of times they're shocked, is they'll say, Hank or Jeremy, I'm a conservative investor, or I'm a moderate investor. And then we have them fill out a risk profile questionnaire that assesses their risk. And sure enough, they're conservative or they're moderate. And then when we do when we look at their portfolio and stress test it, a lot of times, not all the time, but a lot of times they're taking on much more risk than they're actually comfortable with, that they're unaware of, and heaven forbid there's a pullback in the market, they would see a larger decline that isn't in line with how they should be invested. And then, Hank, it can also be the opposite of that.
Well, yeah, exactly. People can be too conservative, where they're so fearful that they're missing out on returns. It goes back to what we're talking about. If you've only got 25% in equities and 75% in bonds, as an example, that's a decent portfolio when you're if properly constructed. When you're taking income from a portfolio, you might want something more stable. So, for instance, one strategy being, when it comes to taking income in retirement and still protecting myself in the market, is I'm going to elect a certain amount, say for 3 to 5 years worth of income, that I'm going to invest more conservatively so that it has less volatility. So when I'm taking income, it's not going to affect that income. And then be more aggressive to stay ahead of inflation and taxes, pull my overall portfolio up by having more 60 to 75 or even 85% in stocks in that part, in my growth part of my portfolio, while I have an income piece. So this is one way that we can deal with sequence of returns risk. Jeremy, going back to the stop loss, and the stop loss is another, by the way. So just as with the fewer equities, so if I get down around 25% equities, stocks, and 75% bonds, right, I'm going to have a lot less volatility. An example being that portfolio, the model portfolio that I use is of 25-75. Back in 2008, when the market dropped almost 40% that one year, this portfolio was only down about 8%. And the very next year, it went up 8%. So it recovered very quickly as well. So that's one way, as I say, to manage risk, in particular when we're taking income. Another is can be where the stop loss overlay comes in, because it's going to limit how much I can lose. So if I'm in a 60-40 portfolio, as an example, and the S&P drops, through say about 12%, then my 60-40 is probably only going to be down somewhere around 6-7%, maybe 8% at the outside. And that's going to move me then into bonds. That's going to protect me as far as a further drop in the market going into a bear cycle. And we've seen this work last year. This worked really well when the market dropped 34% over 22 trading days. This was triggered, pushed into bonds. And then on the upside, when the market's recovering, it has two triggers that get hit that push you back into your portfolio. And that strategy, I think the S&P last year did about 18%, but Jeremy, I think that strategy with the stop loss overlay did 30%.
Yeah, roughly it did. And not every strategy is going to work great every year. That's why we have so many strategies. That's why we have so many tools, to your point, Hank, at our disposal. But yeah, last year was a fantastic year for folks that were utilizing the stop loss, to your point, pushed out in February, pushed back in March. Again, doesn't always work that way, but last year was a great example of the stop loss. And the stop loss, when we came up with the strategy with an institutional money manager that co-created the stop loss strategy, what they did is they looked back at the history of the stock market And what they found was, historically speaking, not every time, but historically speaking, more often than not, when the S&P declined more than 12%, much higher chance of a further decline. That's why we chose 12%. A lot of other managers have an 8% or a 10%. We went with 12.
Yeah, and this is one, and the reason, again, looking at the research, because how often do you get a 5%, an 8%, a 10%? Those happen much more frequently. 12, now that normally is only going to happen going into a bear market. Not, again, we're talking the markets here, there are no absolutes. This is, you know, statistically, it puts the odds in your favor, but it doesn't guarantee that the market's going to behave that way every time. Of course, there are going to be exceptions, but overall, even with the exceptions, I may miss out on a little bit of return, but I'm still going to be protected. I'm still going to attain my goals. What are we really looking to do here? We want to reduce volatility down. All right, one reason for that, because we're going to be taking income from that money. It's no longer just pumping it in as we did when we're planning for retirement. When you're saving and you're just pumping your money into your retirement accounts, we're going to ride out that volatility, right? Maybe retirement's, you know, 10, 20, 30 years into the future, and so we can be even more aggressive. We have time on our side, right, before we're going to start taking withdrawals. But as we go into retirement, now we're going to start taking money out. That flips everything. How you invest, how you take income, all of that, the rules change, and how you invest needs to change as well. Again, if you're not sure about your own situation and you'd like to get a personalized plan, call my office, 615-376-5325. We'll get your information. We'll basically are going to look at your income, your expenses, assets, liabilities. So you're going to have to gather up some stuff to help us do this work for you. But the report we're going to provide will show you your financial future based on what you're doing, as well as the risks inherent in your current plan and how we can share the strategies that I've used and developed over the last 30 years, helping my clients to attain and maintain their standard of living and quality of life no matter how long they live, never have to worry about running out of money, and having the fund money as well, you know, having the discretionary funds so that when you're retired and every day is a weekend, right, that you've got the money for those leisure activities that you enjoy and family and the rest. So this is what good planning is about. The best plans are that take into consideration, God forbid you died in the next few years, everything is in place to take care of your family and whatever your financial goals might be there. And God willing that you live to be 100 plus, right, that the plan is going to work for you. And we run them out that way. We make sure that you're not going to have to run out of money, or that you're not going to have to worry about running out of money in retirement. I'm going to share some more strategies. We're going to get more into this stop loss. First, a break. Join us here. We'll be right back on the Retirement Report.